Recipes for technical trading success in Cook's Kitchen.
Hey, Kevin Cook here, and I want to look at some charts and some indicators and see if the economic impacts are fully discounted. So right now, you're looking at my screen here. I've got the sector overview. Well, this is for one day. We're not really interested in that. We're seeing the bounce back in energy. Oil's up a little bit off the lows. Let's look at a 3-month view. So here you can see the devastation in energy. And I know Baker Hughes just reported a $10 billion loss this morning. What's holding up? Obviously, healthcare is holding up. So much in healthcare is seeing inflows of money, technology as well. So those are and consumer staples. But we'll take a look at technology and what's holding technology up. Let's go to my Fidelity charts here, and we'll just bring up the Nasdaq 100. Looking real strong, and we know what's driving it. Apple, Amazon, Alphabet, Facebook, and Microsoft are 22% of the S&P 500. They're obviously over 40% of the Nasdaq 100, but they're 22% now of the S&P 500, and that means something. And that's what's holding this up. Once my target for the relief rally was Nasdaq 9,000, and by the way, just this year the Nasdaq 100 started trading at a higher index level than the composite. So that tells you something right there about the big guys driving the price action here. I think we go back down. I don't know if we have to test the lows in the Nasdaq, but we're definitely headed back down, and we'll look at where we might test the lows in the S&P 500. So let's just take a look at the S&P 500 while we're here. I'll blow this up. This is a 2-year chart. We made new lows, 2,200. I think it's fair to say we could easily test that. Just technically speaking, the market, we just barely grabbed a 50% retracement. I don't even think we did. Let's say 50% is 2,900. No, actually we did, because the 618 would be 2,950. So we did hit a 50% retracement. But it's weak, right? We're not powering higher. So we've got a short-term V recovery in the index, but there's no V recovery apparent in the economy yet. And if somebody's predicting one, I think we're dealing with a lot more negative unknowns than positive unknowns, which would drive a economic V recovery. There's going to be structural changes. There's going to be bankruptcies. So let's take a look. I wanted to show you, well, let's go to my map. On March 31st, for Taser members, I put together what I call my scenarios and probabilities market map, which is usually good for a period of 3 to 4 weeks. So that was this is what I put together March 31st. So here it is right here. This is just how simple it is. Scenarios and probabilities, S&P for short, market map for April. I just plot the probability so that you know what to expect based on volatility, where you expect the market to trade. And if you look at this, I had a 35% chance of trading between 2450 and 2750, and a 20% chance of getting up to 2950. We got close. Overall, this map implies an 80% chance of the lows holding in April, not of the lows holding during this bear market, but of just in April, because that's how strong I thought the relief rally would be. Okay, it also implies a 60% chance of the primary price action taken between 2250 and 2750. So you can stop the video, analyze this. It's a way of analyzing volatility so you have ideas of what to expect and what you'll do if volatility increases upside or downside. All right. Baker Hughes, we looked at, I mentioned that chart's holding up pretty well here versus their 10 billion loss. What I want to show you is one of my favorite capitulation indicators. If you go to stockcharts.com, just up here at the top, and you type SUP and then an H, you'll get the only selection you can, which is the S&P 1500 new highs minus new lows expressed as a percent. So we had this big capitulation washout. We've never seen anything like this, where this going, minus 60%. So that was, record fear selling capitulation. You wanted to be a buyer there. We were. Now we're back up. Things have normalized again. But I think this thing needs to double dip. This will make a W. We'll see another washout. We don't know how many energy bankruptcies are coming. We don't know how many small business bankruptcies are coming. We don't know how high unemployment is going to climb. So those are all the negative unknowns that we can't be sure about. And this is a very unique recession. There's no standard playbook. Everybody trying to talk to you about the playbook for this recession, I think is they're speculating a bit too much, because there isn't a playbook for this type of recession where we shut down the economy. And yeah, logically, you think it should be able to come back, but you don't know what structural impacts there will be. So I think I covered everything I wanted to. Showed you the map, showed you the S&P new highs, new lows, why I think Nasdaq and S&P are headed lower. Oh, I got one more great little chart for you here. So this is from Michael Hartnett at Bank of America, and this tells you why Microsoft, Apple, Amazon, Alphabet, Facebook are driving the rally, because they became 22% of the S&P 500, and they're obviously over 40% of the Nasdaq 100. This looks pretty unsustainable. This is a safety trade. This is the flight to safety. There's a flight to safety in bonds. There's a flight to safety in the U.S. dollar. But for large institutional investors who cannot go to 10 or 20% cash, this is their flight to safety. Buy Microsoft, buy Apple, buy Amazon, buy Alphabet, buy Facebook, some other quality software that might actually do better during this crisis. And so that could be CRM, Adobe, that kind of thing. So, but they can't hold up the whole economy. Why are they up? Because they are cash generating machines. Not only do they have incredible revenues and incredible profits, they have incredible cash flow and incredible cash war chests. So that's why institutional investors are piling into this flight to safety trade of these type of big technology movers that it can easily adapt. You could throw any economy at these guys, and they will find ways to adapt and innovate. But that doesn't save the rest of the economy. All right, I got to wrap it up here. And thanks for joining me. We'll talk to you next time.